Hey, what's up, stock compounders? Brad here. So today I want to talk about how to beat the market as a lazy investor. Okay. I got a great question on a comment yesterday, and it goes something like this. To be honest, I am lazy to do all this work by myself. And I was wondering if you have ever considered managing money for other people. Not yet is the answer to that question. Also, if not, it would be great if you could cover some low-cost advisory services for picking individual stocks. So this individual, they don't want to do any work, but they want to beat the market. And a lot of you might roll your eyes at that. I applaud that. I think we should be very unreasonable as investors. And there actually are ways, in my opinion, to beat the market by doing very little, okay? And there's a few strategies I've covered in past YouTube videos, and I want to just run through them real quick. So the magic formula investing approach is an approach that was laid out in Joel Greenblatt's book, The Little Book That Beats the Market, okay? And it's essentially, a screener that Joel Greenblatt created. And it uses two criteria that it screens for: earnings yield and return on invested capital. And the intention of those two filters is to find companies that are both good and cheap, okay? And if we systematically buy those companies that are both good and cheap, hold for a year, and then replace those with other companies that are now at the top of the magic formula screener, over time, the results that he's gotten from this, that he's back-tested from this approach, are phenomenal. If you set a minimum market cap of 50 million, I think the annual returns from this strategy, 23, 24% per year. So, take the number with a grain of salt, that annual return percentage. But to me, it makes sense why the strategy works. The second one is the acquirer's multiple. So the acquirer's multiple kind of piggybacks on the magic formula, but it really tries to make it even simpler. Instead of looking for good companies that are cheap, all we're looking for is cheap companies. Okay, that's the acquirer's multiple. It's basically the earnings yield. And, in that book, The Acquirer's Multiple, Tobias Carlisle, laid out, he did back testing for both the magic formula and just the cheap part, the acquirer's multiple, and found that the acquirer's multiple slightly outperformed the magic formula over time. Now, the annual return percentages that he got for the magic formula were different than Joel Greenblatt got for the magic formula. So it's possible that he wasn't using exactly the same calculation for the magic formula. But regardless, both of these strategies have significantly outperformed the S&P 500. Of course, there's no guarantee they will continue to do that moving forward. But I think there's a compelling case that they both will. And if you read either or both of those books, it lays out the case of why these investment approaches work. The third one is the free lunch portfolio. Now, this is something that was created by Mohnish Pabrai. On his blog, Chai with Pabrai, you can read about the free lunch portfolio. And basically, every year you're buying 15 stocks. And there's three different buckets that the stocks fall into. One is Shameless Cloners. So Pabrai has identified something like 9 investment managers that, every year he's cloning the best ideas of these 9 investment managers. And they're the best ideas based on how high of a conviction bet those investment managers are making on those particular companies. So you got 5 stocks in the Shameless Cloner basket. You've got 5 stocks in the spin-offs basket. as Joel Greenblatt laid out in How to Be a Stock Market Genius, when you have a spin-off situation where a company is being separated from a parent company that's much smaller, there's a lot of forced selling. Because if you're an institutional investor, a lot of times you can't own companies that are below a certain market cap, are below a certain size. And so with these smaller spin-offs, there tend to be a lot of forced selling, which can depress the prices for those spin-offs. And you can find situations where they're just mispriced for reasons other than the fundamentals of the business. So that's the second basket. And then the third basket is Uber Cannibals, companies that are eating themselves, companies that are buying back a lot of their own stock, retiring those shares. Because if you own, say you own a certain percentage of a company and it's retiring shares, you're going to own more and more of that company with the same number of shares without doing anything. So that's a great situation for equity investors. And this is something that Mohnish Pabrai picked up from Charlie Munger. He was having a conversation with Charlie Munger once upon a time, and he was basically like, hey, if you were, fishing in 3 different ponds or whatever, which ponds would you be fishing in? Which ponds tend to have more fish in terms of better stock opportunities? And those are essentially the 3 that Munger laid out: spin-offs, Cannibals, and Shameless Cloners. So you can check out the free lunch portfolio. I think the back-tested performance of it is somewhere around 20% over the last 20 years, 20% per year. But again, past performance is not indicative of future performance. But there's a strong, I see why, each of these 3 buckets have the potential to outperform the market. So seems like a great kind of turn off your brain approach to me. And then the fourth one I want to talk about is just cloning a few great investors, identifying investors where you understand their investment philosophy. They are good cloning candidates, meaning they have a very concentrated portfolio. They don't buy very often. Big bets, infrequent bets. So identifying a few cloning targets, like I clone Mohnish Pabrai. I'm starting to get more and more familiar with Phil Town. Could be a future cloning candidate for me. But just picking a few great investors and, every quarter, every 3 months, looking at their 13F filings, or just making it even simpler on yourself, looking at Dataroma or some other 13F aggregator site, and setting rules for yourself of how you're going to buy and sell based on what these handful of super investors are doing. It doesn't even need to be a handful. It can be 2 or 3 super investors that you're cloning every quarter. So that's 4 ways that I think anyone can beat the market by not thinking. Okay. Now, it's not going to take no work. Okay. There's 2 pieces of work that you need to do in order for these strategies to actually work for you over the long term. The first piece of work is you have to understand why the approach works. Okay. If you don't understand why the approach works, you won't stick to it. The moment it stops working, the moment you see that your portfolio is down, you're going to lose faith in the approach if you don't understand why the approach works over the long term. So that's the first piece of homework that you really need to do if you're going to take on one of these approaches. And it's not that difficult. There's already a book for the magic formula. There's a book for the acquirer's multiple. You can read about the free lunch portfolio on Mohnish Pabrai's blog. Maybe watch a few of Mohnish Pabrai's lectures where he talks, about a lot of what makes the free lunch portfolio work. If you're considering the free lunch portfolio, definitely watch his 2012 lecture at Ivy College. He really lays out a case for, how investors can beat the market by doing very little, by turning their brains off and doing one of these kind of mechanical investing strategies. So you have to do the work of understanding why it works. And the second piece is you have to commit to following it for 10, 20, 30 years. And that's really the piece of work that tends to be hardest for people, okay? Joel Greenblatt says the greatest advantage that a small investor has is patience, a long-term perspective. And it's so rare in investing. So, most investors, they're impatient, and another defining characteristic of them is they make emotional investment decisions, okay? So you can be very lazy and do very well if you can master your patience and you can master your emotions and you can understand one of these approaches well enough that you can stick to it. Because the vast majority of investors, they'll stick with it while it's doing well. But when it's not doing well, they stop doing it. They sell off everything and they decide, oh, this isn't working. I'm going to chase after something else, okay? So every couple months, they're changing their investment strategy. And you cannot build wealth by doing that. There's no compounding when you do it that way, okay? Compounding means, you're making money on the money you make, okay? You're making money on the interest that you're earning on your investments. And it's slow to start, but over time, it just takes off. It takes off like a rocket. But most people don't stay in long enough. They don't commit to a strategy long enough to see, that hockey stick growth. So, 4 great approaches, guys, I just laid out for you. They're not going to work every year. That's why they work over the long term. If they worked every year, everyone would want to use them, and then they would stop working. So, really feel into these 4 different approaches. I'm testing the magic formula right now as kind of a small side portfolio. I'm intrigued by the acquirer's multiple, very intrigued by the free lunch portfolio, and I'm already cloning Mohnish Pabrai. That's really the only investor that I'm cloning at the moment. And I'm not necessarily itching for more. Honestly, Pabrai probably buys 1 or 2 stocks each year, and that's enough for me. I don't need to buy, a dozen stocks each year to feel good about my portfolio. I can buy 1 in a year. I can buy 1 in 2 years and be quite content with that. But anyway, that's really what I wanted to share here. You can be lazy and you can trounce the market, but you have to do things differently than the majority of investors, primarily in the area of patience and also in the area of not letting your emotions drive your investment decisions. Okay, guys? Let me know if you've been using any of these approaches, the magic formula, acquires multiple, free lunch portfolio, or shamelessly cloning your favorite investors. I'm curious to hear from you guys. I know a lot of you are shameless cloners, which is awesome. Keep us posted on your progress. It's fun to take on these kinds of approaches, as a community and share what's working, share what we're struggling with, and we can really help each other build wealth over the long term. All right, guys, that's all I got. I will see you in the next video. Take care.